This video is brought to you by Wise. Hi, welcome to another episode of ColdFusion. From GameStop to Wall Street bets, 2021 is set to be remembered as the year of stock market madness. But now, there's been another event that rocked the industry. Family fund Archegos Capital Management has become a landmark cautionary tale about risk management and grief after suffering devastating losses in the billions. Bill HWANG, the man at the center of the scandal, is an interesting character. He was once worth over $30 billion and on track to become one of the richest people on Earth. Though, with his car of choice being a Hyundai, he wasn't your typical billionaire. Starting in 2013, Bill used $200 million from a previous venture and turned it into $20 billion. And then, in just 2 short days, it was gone. No individual has lost so much money so quickly. The fallout from this event sent shockwaves through the market, causing significant losses to share prices, and a handful of banks lost billions of dollars, and top banking executives have been fired over the scandal. So what went wrong? Who was responsible? And what have we learned from one of the biggest financial blunders in recent history? Sit back and relax as we dive into the story.
You are watching ColdFusion TV.
Bill HWANG was largely mysterious to the general public and even the financial industry. It would be only former co-workers and his church members that knew him well. Despite HWANG being worth billions, he only drove a Hyundai SUV and lived in a suburban New Jersey home. This was a clue into Bill's mindset. Being a devout Christian, he didn't believe so much in material wealth, but did indulge in casino-like risk. A paradox, but a key part of his undoing. In 1982, Bill immigrated to the US from South Korea. He was the son of a pastor and raised by a widowed mother. He eventually earned an MBA at Carnegie Mellon University. In 1996, after being a salesman at 2 security firms, he landed an analyst job at Tiger Management. The hedge fund, Tiger Management, was started by Julian Robertson, an absolute legend in the field, and Bill HWANG was his protege. To truly understand HWANG, it's important to recognize just how successful his mentor was. Julian Robertson was the titan of hedge fund management. His career saw him turn an $8.8 million investment from family and friends into $22 billion over 2 decades. 50 former employees of Julian went on to create their own successful hedge funds. This group would be known as the Tiger Cubs, obviously because they worked at Tiger Management. And these Tiger Cubs were the best of the best. Even among this elite class of investors, Bill HWANG stood out to Julian Robertson. HWANG's performance during his time at Tiger Management was so impressive that in 2000, as Robertson was stepping back from fund management, he gave HWANG a substantial initial investment to open a New York-based fund focusing on investing in Asian markets. In 2001, Bill would unleash his aggressive investment style in the form of Tiger Asia Management. Tiger Asia Management grew to become one of the biggest Asian market-focused funds in the United States, turning an initial $1.2 billion into $5 billion at its peak. Former clients and colleagues at Tiger Asia who spoke to the New York Times say that Bill concentrated his stock picks on a few select names and used borrowed money to increase his position. According to a former employee, Bill was secretive, often concealing particularly large holdings from his own analysts. It wasn't until 2008 that attention began turning towards his risky investment style, as he was one of many fund managers that were stung by the monumental Volkswagen short squeeze. Rather than an extensive diverse portfolio, it was clear that HWANG's success relied on a lack of diversity, an investment style that would eventually be his undoing. In this case, Bill HWANG was betting heavily against a small number of substantially shorted stocks. Things would get worse for him too. In 2010, it was discovered that HWANG was being investigated by US security regulators. This was over a suspected insider trading scheme involving Chinese bank stocks. 2 years later, he pleaded guilty to criminal fraud charges, admitting that he used confidential information for the basis of making profitable trades. These illegitimate profits amounted to $16.2 million. In the wake of the controversy, Bill's hedge fund, Tiger Asia, was ordered to forfeit $16.2 million, as well as a further $44 million to settle in a separate legal case. HWANG decided to accept responsibility for his actions and return outside capital to investors. Although pleading guilty to fraud and insider trading, to the banks, HWANG was still seen as somebody who could make them buckets of cash, and for that reason, they were still willing to loan him massive amounts of money. He just needed another venture to get back into the game. After closing down Tiger Asia, he turned it into a family office. It would be at this point that Archegos Capital Management was born. Archegos became the Christian family values fund of HWANG's dreams. Everything from the name, which in Greek loosely translates to Prince of Christ, were influenced by HWANG's Christian views. HWANG said that his intention to be a great investor is all for the purpose of benefiting society and pleasing God. He claimed that the insider trading charges revived his Christian motivations, and he now would use his wealth to sponsor Christian organizations throughout the US and South Korea. Regarding these donations, HWANG said, quote, "I'm decreasing the amount of money under my name in order to do the things that God loves," claiming, quote, "I do it because I like God more than I like money." With quotes like that, you would think that Bill would play the market safe, but his strategy was anything but safe.
It's in God's heart and it's my heart that a lot of people in investment community and these companies would know the reality of God. And then creating culture, which is God honoring, serving one another and learning, doing, where it's not all about money, but it's about long-term. God certainly has a long-term view, and it's really helping a lot of people learn how to invest well and use capitalism to help human society advance.
In the grand scheme of things, Bill's trading strategy was strikingly simple. Archegos would borrow a bunch of money and stuff it into stocks that Bill believed would go up. Stocks such as the Chinese internet search giant Baidu, Shopify, and Viacom CBS. After doing fundamental analysis, that is, focusing on world trends and studying companies' financial statements, he built a highly concentrated portfolio around his stock picks. Anyone on Reddit's Wall Street Bets can pretty much do the same thing, except in Bill's case, he had hundreds of millions of dollars in borrowed money to play with. With an initial sum of $200 million from his previous venture, HWANG spent the past decade investing, successfully turning that $200 million into an estimated $10 billion. But the thing is, while Archegos managed to amass $10 billion of its own money, its positions were valued closer to $30 billion thanks to a little trick called total return swaps. And this is where the story begins to get really interesting. While total return swaps aren't illegal, they are considered a risky, controversial way to boost profits. They're investment contracts brokered by banks that enable investors to take large positions without needing the funds up front. Essentially, in a swap, a hedge fund pays the bank a fee to gain exposure to the profit or loss of a stock without actually owning the stock itself. It's all based on the trust and understanding that the borrower can cover the positions if the stock doesn't go in the right direction. These return swaps also had the added benefit of hiding Archegos' name from appearing on the books of financial dealings. An outside viewer would only see the bank's name holding the position, not Archegos' name. According to the New York Times, even the firms that finance Bill's investments couldn't see the big picture. This is how Bill HWANG and his Archegos fund managed to stay so secretive. In the United States, there are rules that prohibit the purchase of financial assets with over 50% borrowed money. Interestingly, no such limits apply to hedge funds and family offices. So, Archegos went wild and consistently increased their leverage. To begin with, it was an amount of around 2 times, or borrowing $1 million for every $1 million of capital that they actually had. But by late March, the leverage level was over 5 times. And where Bill HWANG took the extra risk was in the number of banks that he had the swap agreements with. Due to the Archegos reputation, each bank trusted Bill HWANG and trusted that Archegos had the collateral to be able to cover the positions. But what each bank didn't know is that they were one of many, 6 in total. Goldman Sachs, Morgan Stanley, Credit Suisse, Nomura, Deutsche Bank, and UBS. Each bank understood the risk that they were taking individually, but not as a whole. By scattering his share through multiple return swaps, Archegos was able to make loads of profit without revealing themselves as major investors. And as crazy as it was, this extremely risky bet was paying off. While the hedge fund's actual capital rose to an estimated $20 billion, the potential raised through swaps exceeded $100 billion. Luckily for Archegos, things were going well and would continue to do so as long as the market moved how HWANG predicted. Of course, it didn't. Before we continue, I just want to give a shout out to today's sponsor, Wise. As you're all probably aware, the traditional banking system has its fair share of drawbacks when it comes to international dealings. If you're a person that's looking for a fast and cheap way to send money overseas, whether for business or family, Wise, formerly known as TransferWise, makes it easy. Wise is 7 times cheaper than traditional banks, with no hidden fees. You can send or receive money instantly in 50 different currencies between 80 different countries. I've already used the service myself when I had to pay for some illustrations while I was writing my new thinking book. By clicking on the link in the description, you'll get a free transfer of up to $500. Clicking the link helps support the channel, so thanks. By March of 2021, Archegos and the 6 banks held substantial long positions in a handful of successfully performing companies, but things started to fall apart when Baidu and Farfetch share prices both began to drop. And on Monday, the 22nd of March, Viacom CBS, which HWANG held a $10 billion stake in, announced an upcoming sale of common stock that caused a massive sell-off and a 20% dip in the share price. Bill HWANG's risky investment model was suddenly unraveling. A few bankers pleaded with him to sell shares, as he would take losses but survive, avoiding a default and a total wipeout. HWANG refused. If the stocks in his swap accounts rebounded, everyone would be fine, but if even one bank flinched and started selling, they'd all be exposed to plummeting prices. It was a game of chicken with very high stakes. The losses began stacking up, and Archegos started selling off other stocks in its portfolio to offset the losses. But this caused a problem. In doing these actions, Bill HWANG no longer had the collateral that had given the banks assurance in the first place. Archegos had lost the leverage that convinced banks to offer the return swaps in the first place. The banks wanted more money as collateral, and Bill didn't have it. It wasn't long before the banks noticed that Archegos wasn't going to be able to cover the collateral. In an attempt to minimize losses, representatives from Morgan Stanley, Goldman Sachs, Credit Suisse, and Nomura met to discuss the best course of action. Credit Suisse and Nomura, who knew that they would face the biggest losses, suggested working together slowly to undo the damage over the course of a month. Though, ultimately, the banks failed to reach an agreement, and it became a race of panic selling. The next morning, without consulting the others, Morgan Stanley threw the other banks under the bus. Goldman Sachs would be next, as they believed the market would catch wind of the situation within days, and the losses would maximize. This quick action and going behind the other banks' backs led to both banks being able to avoid major damage, but their massive sell-offs triggered a further decline in stock prices. By the time the other banks involved managed to move the now toxic shares, the damage was done. Credit Suisse says it will lose $4.7 billion and now have removed 2 executives from the company over the incident. Nomura will lose $2 billion. The other banks got off lighter, but not lightly. It has been reported that between the 6 banks involved, an estimated $10 billion was lost. According to Bloomberg, Bill lost $20 billion in 2 days, and Bloomberg described the situation as one of the most remarkable failures in modern history. It is truly a historical loss of wealth in such a short period of time. Despite this, HWANG is optimistic about the future of Archegos. Insiders predict that the family office would inevitably file for bankruptcy in the near future though.
Well, look, this is devastating. The losses they took versus everybody else, I know that the risk control chief has been traded, but I think the whole management has to go. I mean, this is one of those things that's just unforgivable. If you don't know how to handle a busted client, then you shouldn't be handling anyone. And this is, it's just a really dark day for Credit Suisse. Wow. This is remarkable, and I think that Credit Suisse has to completely reevaluate itself, and I think the regulators have to reevaluate them. I'm not sure they know what they're doing.
The global fallout from this blunder has sparked renewed conversation about how family funds are regulated and monitored. It is estimated that family offices hold assets in excess of $6 trillion globally, twice the size of hedge funds. Despite these staggering numbers, details of family offices are largely hidden both from the public and regulatory authorities. Disclosure requirements for family offices are extremely minimal compared to hedge funds and could be insufficient considering the power they possess to influence the global market. After the global financial crisis of 2008, the United States passed the Dodd-Frank Act. This dramatically tightened regulations for the financial industry, but due to the cause of the crisis, the Securities and Exchange Commission exempted family offices. This kind of makes sense on paper, as Angelo Robles, founder and chief executive of the Family Office Association, said, quote, "If it's their money, they can do what they want, just like the average person. Why should they be disclosing things?" End quote. But incidents like Archegos call into question how much control these unimaginably rich families can have over the direction of financial markets. Perhaps there should be a monetary threshold where above this amount, you're required to disclose more information. Bill Hwang's actions have cast a light on the need for tighter regulation, heightened transparency, and a reassessment of the inadequate laws that govern family offices. In a time where wealth is becoming more concentrated each and every day, something needs to change if we are to have any hope of something like this never happening again. In the grand scheme of things, it can also just show how temperamental stocks can be, especially if you're playing a risky game. With such extensive leverage and little diversification, Bill Hwang was playing the casino, and he lost big time. So if you watched the previous episode on the $11 billion fraud that was WorldCom, you might be interested in this next tidbit. I had someone from the ColdFusion Discord mention that he knew Bernie Ebbers. He had been to Bernie's house and took note of just how insane it was. According to this Discord member, Bernie was a nice guy, but just stupidly wealthy. I thought it was just some interesting insight. If you want to join the ColdFusion Discord and have a chat about video topics and many other things, links will be in the description. So that's it. Thanks for watching. If you want to see anything on business, technology, science or history, be sure to subscribe to ColdFusion. My name is Dagogo and you've been watching ColdFusion, and I'll catch you again soon for the next episode. Cheers guys. Have a good one.
ColdFusion. It's new thinking.
Just